I can do it.
Alex, by the way, this is like the first time that I'm hearing your voice in the past like 4 weeks, so
I know.
don't mind me freaking out, okay?
The past.
Go for it, Alex.
Alrighty. I'll go ahead and offer a prayer if you guys are okay with that.
Yeah, go ahead.
Our dear Heavenly Father, we're grateful for the day we have had and for the opportunity we have to be here together as students to be able to learn more about this case study and to be able to hopefully apply it in our future careers and lives. To have an open mind and be able to listen to other people's suggestions and that we'll be able to learn from one another. We're grateful for this platform that we have to learn, and we're grateful for the opportunities that we have to be able to continue our knowledge, and we pray for us and direct us in this conversation. We pray for these things in the name of thy Son, Jesus Christ. Amen.
Amen.
Can you guys hear me?
Yeah.
Yep.
Oh, awesome.
Yep. All righty.
Okay, so since Tony the Tiger is not here today, he's asked and called me that I step in his position while he's gone. So
Awesome.
Can you guys hear me all right, by the way?
Yep, it's fine.
Yep.
And I got sorry guys, I got sound canceling earphones and a family full of people in my living room. So here we go, ladies and gents. Okay. Anybody got a spiritual thought? Nope. Okay, sounds good.
No, I don't.
We'll move along here. Okay. Put your shoes. Oh, whoa, hold on. Put yourself in the shoes of Brentwood Associates Management. You must decide whether or not you will exit Zoe's Kitchen now, or if so, what is the best exit option? As a group vote, what should Brentwood do with Zoe's Kitchen? IPO now, sell, or do a strategic buyer or financial planner? Wait to grow the business until it's more valuable before exiting. What are your thoughts?
Well, I don't know. When I was listening or reading through it, and they were talking through the market, they were talking about Noodles and Company and other things, and how successful people were being. It looked like if they went with the IPO, and they even had that research group, whoever check it out, if they did the IPO now, they would have a greater chance for success. The strategic buyer, though, or whatever it was, where it says they could buy it, like buy a share of it, sounded pretty enticing, but I just wonder if the IPO would be the best bet. It's hard to tell.
It was hard to tell. If I can go next, sorry, just to jump in here. Like I was waiting for somebody to go first to see exactly what the pulse was, but I agree on the same thing. I think after looking at what it looked like for these guys in the long run, it just did not look too hot. And so it's like, you know what, if they can go public with it, great. But at the same time, maybe find a strategic buyer to actually just buy it out, because that looks like the best way to exit for these guys.
Yeah, I had a few thoughts. I mean, I think that it was too early for an IPO personally. But this is all coming from Brentwood Associates. I didn't see anything that said what percentage that they own of the company of Zoe's. Did any of you guys see anything? I was trying to look through the exhibits.
No, I didn't see anything.
But I don't know what percentage they have or what kind of pull they have with Zoe's Kitchen. But it sounds like this is a decision that maybe they don't even have any say in. I mean, maybe they can guide Zoe's Kitchen one way or the other, but it sounded to me like it's a decision for Zoe's Kitchen to make, and that they shouldn't. I mean, Brentwood probably wants to have an exit strategy, but I mean, if Zoe's isn't ready, I don't know what they can do to force them. So that was my first question.
Well,
yeah, because I remember seeing anything that said how much of ownership they had. Looking through the numbers. Trying to see if there was anything.
Yeah.
Which makes a huge difference. I mean, if they're just the minority, they don't have much say.
Well, it looks like Brentwood bought.
There we go.
Didn't they own the
on
majority?
October 31, 2007, Brentwood and its affiliates closed on their majority investment in Zoes Kitchen. So they own the majority of it. They are
They own the
basically calling the
okay.
shots.
That's what I thought. That's what I thought I had heard was that they own the majority of everything.
Okay.
Yeah.
Well,
So-
if that's the case, yeah.
But we didn't have
Okay,
any numbers specifically that was in there, right? There was no numbers provided, right?
Not as far as the percentage, no.
Yeah, it just says majority.
So I'm kind of along the same lines as like Alex. I mean, I don't think they're ready to go ahead and do their initial public offering. I mean, they've got $11 million is what they were looking at as far as their after or before tax earnings, and it's going to cost them somewhere in the neighborhood of $13 million just to do their initial public offering. I mean,
How
that's
crazy
massive.
is that? That's
I mean, now
huge.
granted, they're going to get, there's going to be a huge influx of cash as far as that goes when they do that initial public offering. But it would just seem like wait, I mean, even if they waited 3 years and the IPO market wasn't looking too hot, they've got lots of people that are interested in them from the private sector through strategic buyouts or financial buyer. Like they've still got exit strategies. The only time you really run out of an exit strategy is when you no longer have a profitable business. As long as their profitability, they maintain their profitability and they keep going forward with that and expanding, like they always have an exit strategy. In my opinion.
But I think, like it said in the thing, the main drawback though was valuation. The going public had the greatest valuation for their company, I guess. If they were saying, I think I don't remember what it was, but 20 or something times for IPO and only like 10 times or something like that if they went private.
No, I think like the strategy one. If you go back and look at the strategy deal,
I'm trying to find it. Yeah, because under sale to a financial sponsor, strategic buyer, that's where it's actually where it says it. The average multiples paid by financial sponsors and strategic investors were 8 times and 13 times, respectively, and compared to the average current valuation of 21 times trailing EBITDA, earnings before income tax, for publicly traded fast-growing restaurant companies. So I guess that was kind of their big, like, half as much valuation if they stayed private compared to if they went public.
I still thought as well, and to Parley's point as well, what he was saying of just how much it would cost, that $13 million just to go through the IPO process. When you look at what they're already sitting at and how their net income is already not looking too hot. They're at the ending period. I mean, they're not walking away with too much, right? So with all that, I mean, you play a game of what ifs, right?
Yeah.
Yeah, but so just in that same paragraph, not to interrupt you, but
No, you're fine.
it says Darden Restaurants, a public full-service restaurant holding company that operated concepts such as Olive Garden and Red Lobster, were said to have recently acquired Yard House, a 39-unit gastropub restaurant chain at a 20x EV evaluation. If Brentwood could obtain a similar outcome for Zoes, it would generate net of fees investment returns comparable to those of the IP without having to endure the headaches and uncertainty of the IP process. Sorry, that's the one that I remembered. I'm like, well, I mean, if you can get just as much right now with a private deal, and you know, from the sounds of it, they're doing really well. So I don't know why they couldn't come in at that same kind of, you know, evaluation.
Yeah, I mean, I guess like to me, it's like if they could get that, heck yeah, go for it. But if they end up in the more of the averages of the 8 and 13, but yeah, because yeah, I'd rather. To me, I'm with you. Like if you can skip the IPO, skip all the legwork, and work with a private investor or whatever way they want to go with that, and just get it done, that's what I would do. But
Get it done, sell it, get out of there.
Yeah. So,
Yeah, I
so
mean-
my vote would be, I mean, it's kind of a deal. Would be like either attempt to do the private equity, or private, you know, the financial sellout, either full or partial, or just wait. I mean, right now it doesn't seem like there's anything that would hurt them to stay. I mean, their investment's doing really well. And that's one of those deals where, like, okay, we close ourselves out, we get our money back. Now we can move on to some other investment. But that some other investment may not be any better than the one we had, and likelihood it's even worse.
Yeah.
We don't know anything about it yet.
Yeah, I agree. That's what I couldn't understand during this case study was what their hurry was.
yeah,
I mean, why they were in such a big hurry to get out. I know it said they wanted to boost their portfolio and show a win. To me, that doesn't justify the risk.
If I can jump in there really quick, Alex, I think he was talking like at the very beginning of the case. He saw what was going on with Noodles and Co. or Noodles and Company, and I kind of put myself in his shoes at the very beginning, and I think he was just talking about they were looking at it because they could see what the turnoff or what was happening with Noodles and Company, and he was like, well, what if, right? It was that game of what ifs. That's the way that I saw it, at least. I'm not saying that's the correct answer, but that's kind of the way that I saw it.
Yeah, but I think part of it is just the fact that, like, they're in the private equity, it says their normal spin-off is, you know, that 5 to 6 years. So that's just the way they do business, is they want to,
right.
you know, spin everything off, and that doesn't necessarily, that may not be the best policy in every case, and I think that this may be one of them. They started with a company that was very small to start with, and the company's been growing rapidly, but it's still kind of small. Like, just let it grow, you know?
Yeah. Well, I think, and if we can, because we're just touching on this just a little bit, that next point is talking about why exit now? What are the reasons out for holding now? And I know we just kind of touched on this, but to kind of get everybody's idea on it. And then also the last is, what is the right scenario? What can go wrong in that perfect scenario?
Well, I think that we've touched on it, that the reason they kind of want to exit now is because it's just procedure. You know, they hit a certain amount of years and like, okay, we should be really looking on getting on and exiting. But the thing is when they bought this company or got into it, it wasn't just within months or a year or so that the recession happened. And so to me, it's like that time during the recession should almost be removed from their time of the company. So they say, hey, we might have had it for 6 years, but 2 years we were rebuilding after that. So really, we've only got about 4 years worth of time invested in this thing when it's actually been profiting. I mean, it was a unique situation, and I think for reasons for holding on is because it is doing well. It's a company that is booming, it's growing. There's a lot of interest in it right now, and the whole market for that fast casual dining is blowing up. And like they even said, it's like a resilient market. It keeps going even as the economy does ups and downs. It kind of stays steady. So I think, you know, what can go right is that they can continue making money. They'll get more profitable, and they'll be able to make more money if they do sell it to a financial buyer, or they'll get more profitable. They'll be able to go public and be worth more money. Now, obviously, what could go wrong is the market. Who knows what the market's really going to do? But chances are you're not going to have a recession or after a recession. So the thing is, they've got a good model. They've got a good team. It's working for them. You know, they might as well just either hold on to it and let it grow to be something bigger, or sell it while people are interested in it. So,
yeah, I think one of the reasons why they were wanting to sell I mean, or at least they were thinking about it. It's because there's kind of they called it the hot IP window.
Mhm.
You know, there was kind of a really, really good IP. I mean, the IPOs have been really good lately. And they want, you know, but there was no guarantee they could start that process and things decline, and then it wouldn't be good. It just seems like a knee-jerk reaction, and that's kind of my gist of it. You know, but basically it was like, oh, things are really good right now as far as getting an IPO sell. So let's go that direction.
The time on it for me was the most dissatisfying thing. How long it took, and I understand that there's things that have to be done and processed everything, but the amount of time that I was going to take these guys to get that done was just so. I mean, it's like, oh, what's going to happen a year from now? What's going to happen in a couple months from now?
Yeah.
That's the one thing that it was go find a strategic buyer, just go find a financial buyer, go find some other route, because if you're looking to get out of this thing, go find a short term, because in the long term, if you want to hold out, like Parley was saying, and see if there's a sunnier day later on. But if you're looking to get out of this thing, right? Don't run the risk and hurt yourself long term. And the company's name too. That was another thing that I saw in the case, was the company's name and their future of their clientele or whatever that might look like. That was something else too. So, anybody else have anything to say on that one?
No, I think everybody pretty much covered what we talked about.
Perfect.
Yeah.
Okay, so the worth of I'm also just realizing that Tony the Tiger is a lot better at this than I am. So okay, so how much is Zoe's worth under each exit option? Discuss with each other how you got your answers as a group. Come up with consensus as to what Zoe's is worth. What are the differences did you observe in the valuations based on the buys in the company? Does this make any sense? Discuss in your group. Why would anyone sell it to financial buyer instead of an IPO? Now, we kind of touched on a little bit on this. Sounds like we've already shared a little bit of what each other have found so far, but does anybody want to add a little bit more to what they found as far as their worth, or what the worth was at their exit option?
Well, I think it was 11 million, right, from an IPO standpoint.
What's that?
Didn't you say it was 11 million from an IPO standpoint?
Well, they were making $11 million is what they were making. Which, if you do that times 21, would put it at 231 million.
Yeah.
Mm-hmm. If you know, and looking at it, like, you know, Noodles and Company, their last 12 months average is like 40.2 to 1. I mean, that's just massive. But then, like, Buffalo Wild Wings is like 10 as far as that goes, as far as their trading multiples. You know, Chipotle, you know, is in that same, you know, around in that 2021 area. And I think so. That's actual revenues. Forward revenues is like, so estimates going forward. You know, it's a little bit lower. I mean, Noodles and Company is still in the 30% range.
Well, yeah, and it said, you know, I mean, financial sponsors paid 8 times EV, and investors paid 30. They bought that gastro pub for 20 times EBITDA. So I think it obviously makes sense that if you were to sell the company to a financial sponsor or strategic investor less money up front, but it's a guaranteed price. You know, the risk is gone at that point. They are taking on the risk, so they need to be able to have a reward for their risk as well. So I think that's one of the main differences.
So it's kind of an odd question because, I mean, like what can you value the company at? Well, I think, you know, based on what we're here, the average, you know, is about 14% or 14 times. So if you run that number, like, what does that give you? But like, there's just so many different things. Like, how are those other companies growing versus this one? You know what I mean?
Right.
And okay, so this is the way that I looked at the case, and you can give your input if you'd like to, but I'm gonna take you down Carner's Avenue really quick. So the way that I saw it with hers is that she has something, or Zoe, we just have a brand new CEO. This company is somewhat of a niche. It's Greek food, and so you don't have many folks who might be eating that. I don't know about myself, but I haven't really eaten Greek food all that often. It looked, I mean, the pictures that were inside as far as the exhibit goes, they looked pretty satisfying. I mean, they looked great. But that also, I mean, if you look at their operational costs, that's another huge thing that's coming out of everything, right? And so they're having to go up against that every single month. And so, yes, it's visually appealing, but is it really a market that's pretty open to a lot of folks? Are there a lot of people that come through? And it said in the case that there were, and that they were very satisfied. But to catch up with Noodles and Company, that's a huge company, right? And they're expanding like crazy. Is that gonna do? Are you gonna do the same thing if you go public, right? Like, what does that entail? So there were a lot of, I don't know about you guys, but I felt like there were a lot of just what ifs. I feel like this case should have been called the what if.
Yeah, we've had one like that before.
Well, another argument against going public is kind of along that same lines. Like, the whole public deal, they're going to spend, it was like $13 million to facilitate the sale, but on top of that, it was going to require almost $1 million a year just to meet the publication.
Yeah.
1 to 2 million could expect to incur $1 to $2 million annually in reoccurring costs just to meet the, sex,
Oh yeah.
investor relations crap. So
Yeah, SEC and
SEC.
oh yeah.
So you're talking. It came out wrong the other way. I thought about it after I said it. But anyway, $1 to $2 million a year when you're only making 11 million right now.
Right.
Like the cost benefit there is like totally skewed. You're talking about 10 to 20% of your revenue just because you're like, ooh, I'm gonna go public. Now, granted, if they get a huge slug of cash there, then they could they could expand a little bit. But like, still, why not wait until that $1 to $2 million is spread across a much bigger revenue pool? I mean, the amount of money that's going to be spent to meet those regulatory things is not going to change that much for an $11 million company, revenue versus 20 million revenue. You know what I mean?
Yeah.
You're talking about accounting processes. You know what I mean?
And didn't Noodles and Company go public in 2010? Is that what it was?
Yeah, I think that's what I read. That's what I read.
So if you look at that sheet, they had 255 restaurants, while Zoe's has 57. They had 220 million in revenue, while Zoe's is showing 50 million in revenue. And so it's like, it's such a huge difference that I just don't know if it really is. Like, as we're saying, $1 million a year to keep it up, and the more stores you add, the more investment you have to put in, and it's just, I don't know. I don't think they're ready.
Yeah. If you go too early, I mean, I don't know. This is just, I've heard this before. If you rush an IPO, it's gonna be more harmful than it is good to the company. I mean, right now, you know, Brentwood might be able to get a little bit more revenue out of it, but in the long term, he might just be setting up the company for failure. You know what I mean?
See, but it's not like they're just jumping into it though, because they did have that company, that investment analyst company, whatever it is, look into it pretty deep, and they like, yeah, we feel like you could go public in a few months. So I mean, they've got a company trying saying, yeah, you can do it. They've got their CEO saying, hey, it'll make us more popular. We'll be able to be well known. We'll make more money. And we got them as investors going, man, if it fails, we're gonna lose a bunch of money, and we can just take the easy way out. So I don't know.
Okay, so let's do this because I feel like, and once again, correct me if I'm wrong, but I'm just going to ask that ultimatum question here. Put yourself back in their shoes. What would you do? And this might act as the summary part of this, but what would you do?
I would wait.
You would wait?
Yep, absolutely. You
Okay.
got a good thing going, like just let it keep growing and go, get itself in a much better position. Again, a little bigger company, you're going to be able to absorb that, absorb the IPO costs. I mean, if you're absolutely desperate, and that's the thing is we don't know how desperate Brentwood is to get out of that position. If you're desperate, then go with a private side and try and get an evaluation closer to that the 20x like Yard House got.
I agree. I think they've got too much potential to give it up. I think Brentwood's sitting on a gold mine if they're just willing to harvest it the right way. I mean, they said that they're projecting to grow by 40 stores, I think, after 2013 or something like that.
30.
30 stores? Okay. I mean, they just need to ride this wave out. I mean, I think they should wait as well.
Yeah, based off of their sheet, the balance sheet, whatever it is, that shows, Zoe's Kitchen 2011, 2012, and the predicted 2013. I mean, I think that the money they're spending now, investing in that company, making these fine tunes, and it took them a couple years even to see to reap the benefits that they were sowing. And so I think, man, give it some more time, get those store counts up a lot higher, get it to where the revenue is a lot higher, where you've got more to work with. And so that way, when you do have these high dollar fees you have to pay for being public, it's not going to be 10% of your yearly income. It'll be, 3 or 4%, somewhere in that ballpark. I think that you're right. They've got a company that is doing great. I mean, it's showing double-digit same-store growth, which is, like as they were saying, it's almost unheard of. And that's not something that should just be like, hey, let's just get rid of it in case it fails. I think they should work with it because it's been moving well, and it's showing in the numbers that it's going to continue to do well. So yeah, I think they should wait, let it get a little bit more mature, and then go from there.
Okay, so let me lay some wise Connor wisdom down on y'all on this beautiful Saturday night. Just kidding. I agree with what everybody has said so far. Waiting it out and seeing what's going to happen when you look at I think it was that Exhibit 7, and you look at exactly where they're at, what they're doing. Yeah, there's quite a bit of red for these guys, but at the same time, you never know if they're seeing some good things coming around. They also had that new CEO that was coming in. Maybe give this guy some time, see what he does. Might turn around for the better. You never know. But in all the what ifs of this beautiful Saturday night, I just want to let you guys know I think they should wait it out. How was that?
Man.
Is that beautiful? A little ending point for y'all. I feel like we're completely all off tonight. Am I wrong about saying that?
I think
Well,
if
maybe
the
it's
mids,
because you actually agreed with the rest of us, and so it just feels off because you're not contrary.
It's finally happening. I'm finally starting to get in tune.
So yeah,
What's up?
nothing.
Okay, boys. Well, I think that's a wrap.
I think you can cut the live feed.
That was pretty
okay,
pretty simple.
I'm gonna stop us.